In our recent investment outlook piece, we highlighted that the factors of economic growth, earnings momentum, and innovations from artificial intelligence would continue to support risk assets in the new year. Economic growth in the US has been strong in 2024, despite initial worries of weaknesses in the US labor market. The strength of the US economy is expected to continue into 2025, and the FOMC has since adjusted, with fewer cuts guided in 2025. The European economy is weak, and we are pessimistic of a strong recovery in the new year. Europe lacks political leadership, and its two largest economies, Germany and France, are currently struggling with political gridlocks. On the monetary policy front, we would expect the ECB to continue cutting rates over the next few meetings to address concerns of slowing economic growth. China's economy is improving with stabilizing property sales, consumption lifted by government policies, and stronger exports potentially from front-loaded demand from US tariff risks. We are moderately positive on China's economy, with expectations that policymakers in China would deliver on their commitments to adopt a moderately loose monetary stance and proactive fiscal policies in the new year. Market surveys have indicated that institutional investors are most bullish on the US equities market. Investors view a unified US government after a Trump victory as being positive for the US economy, as key policy proposals such as tax cuts and deregulations are positive for the US stock market. We are also positive on US equities, but will caution that stretched positioning means that negative news such as announcements of more tariffs or large-scale deportations could lead to a sell-off in the US stock market. Besides US equities, we see many investment opportunities for Asia equities in the new year too. We are positive on Taiwan equities. We could see heightened volatility when Taiwan is caught in the crosshair of the US and China rivalry. But artificial intelligence is a long-term positive trend that would be supportive for AI supply chain related stocks in Taiwan. Korea equities has corrected on continuing political uncertainties, and past impeachment cases in 2004 and 2017 suggested that the deep discounts in Korea equities could reverse when political stability returns. We have turned more positive on India equities after healthy corrections in recent months. Sentiments are no longer too optimistic, and initial public offerings are no longer viewed as sure win bets. The India stock market has also become more sensitive to valuations, which is healthy. We see more opportunities for stock picking in the India equities market. We are longer-term positive on Japan equities despite policy risks from the incoming US administration. It remains to be seen if the current political leaders can strike a similar rapport with Trump, as former Prime Minister Abe did. But Japan equities is supported by structural growth themes such as factory automation, continuing inbound trend, and corporate restructuring. Singapore equities market is trading at a discount to its long-term historical average, and its dividend yield is attractive compared to other developed markets. ASEAN equities could play a role in a diversified portfolio, as ASEAN's growth is more driven by domestic factors. And ASEAN could benefit from trade diversions and capital flows, given its neutral stance to the US and China rivalry. We see the moderate macro environment as positive for Asian credit bonds. All-in bond yield is attractive by historical standards. Asian credit bonds are leveraged to potential bond price rallies if US interest rates move lower on continuing rate cuts. Credit spreads, though trading near historically tight levels, could remain stable on current economic, corporate fundamentals, and low issuances.